Hi, good evening, everyone. Now, can you hear me or not? Can you see my slides? Are you ready? I can see some of you answer the chat box. Some of you already use the emoticon. Very good. Yes, I can see you are ready. Now, welcome to our East Malaysia CPO webinar series. This webinar series is brought to you by Bursa Malaysia Derivative. Our topic for today is how to diversify your portfolio with commodity futures. And as usual, our session, we are going to divide into two different sessions. The first 60 minutes, we are going to have both our heavyweight speakers to present their topics, and we are going to follow by 30 minutes of Q&A session. My name is Ting Ting. I'm your moderator for this session. Now, before I start, please make sure that you check your speaker, make sure that you can hear us, you can see our slides. So if you can hear us, you can see our slides, then you are ready to go. I just give you 1 second to check whether you can hear us, you can see our slides or not. Now, please make sure that you turn off your video, because you know that if you want to have a very good quality throughout the session, you must turn off your video. Now, subsequently, along the way, if you have any question, you don't need to wait until the end of the session to ask your question. Along the way, while our speakers are presenting their topics, if you have any question, at any point in time, you can type in your question in the Q&A box. So once you type in your question, then you just need to select all co-hosts and you just need to send to us. I repeat, please do not type your question in the chat box. Just type a question in the Q&A box and please send it to all co-hosts. We are going to answer all your questions at the end of the session. Now, as usual, this is the third session and we are going to have a lucky draw session as well. So we are going to give away Touch and Go e-wallet, each worth RM 100 ringgit Malaysia. We are going to give away 5 prizes. So to become a lucky draw winner, just stay with us until the end of the session. We will let you know what you need to do to become one of the winner. So congratulations for those who already won previously, and just stay with us until the end of the session. Now, please allow me to introduce our first speaker. Today, we have both our very heavyweight speaker, not in terms of their size, but in terms of their title, and also because they are representing both exchanges. Now, first speaker for today is Nelson Lau. He's the representative from Bursa Malaysia Derivative, and he's currently part of the commodity derivative team in the product and market development department. He's tasked with developing and expanding Bursa Malaysia derivative suite of commodity products in order to meet the market needs of the industry. Now, I'm not quite sure you are ready or not. If you are ready, please allow me to invite our first speaker for the day, Mr. Nelson Lau. I pass it over to you, Nicholas.
Okay, is the slide clear?
Good to go.
Okay, thank you. Good evening, everyone. Thanks, Ting Ting. So my name is Nelson Lau. As Ting Ting mentioned, I'm part of the commodity derivatives team in Bursa Malaysia Derivatives, and today's presentation will be on our products, more specifically our palm oil products, and then I will touch on our newly launched East Malaysia Crude Palm Oil Futures Contract, or FEPO for short. Okay, a bit of background of Bursa Malaysia Derivatives. So we call ourselves BMD for short. So we are a subsidiary of Bursa Malaysia Berhad, established in 1993. We offer both commodity and financial derivatives products. Our flagship product is the Crude Palm Oil Futures Contract, or FCPO. I'm sure many of you know the FCPO contract. So the FCPO contract is the global benchmark for the pricing of crude palm oil. And all of the products that BMD offers are traded on the CME Globex electronic trading platform, which provides easy access and connectivity to the global market participants. This is a snapshot of the product offerings that we have here on BND. So we have under commodities, the agricultural and metals products. And then on the other side, the financial products, we have the equity, interest rates, as well as bonds. So today's focus will be on the FCPO and the FEPO. But of course, our other flagship product, which is under the equity financials, is the FBM KLCI futures, or FKLI for short. Also, just another point to highlight is that under our product offerings, we have a mixture of futures products as well as options, as you can see from the light blue and red highlighted boxes. Okay, a bit on the Malaysian palm oil landscape. So I'm sure many of you know palm oil in Malaysia, it's a big part of the Malaysian culture and the Malaysian economy and society. So these are a few key facts and figures which I felt it will be interesting to share with everyone here. So of course, firstly, the palm oil industry is one of Malaysia's primary industries, and it takes up the largest share in the Malaysian agricultural sector. So it takes up approximately 3%, or sorry, not takes up, it contributes approximately 3% to the Malaysian GDP. So it's very clear that it is a big part of the country's economy. And secondly, Malaysia is the second largest producer of palm oil worldwide, the first being Indonesia. And one of the largest export markets for Malaysian palm oil would be China and India, as well as the EU. So locally, it's important domestically, but also internationally, our palm oil is accessible and used by many international players. And just some numbers for you guys. In 2020, last year, Malaysia accounted for 25.8% of the world's palm oil production and 34.3% of the world's palm oil exports. So just some facts and figures, food for thought for everyone. Okay, zooming into our flagship product, which is the FCPO. So what is FCPO? FCPO is a ringgit-denominated crude palm oil futures contract. It provides market participants with a global price benchmark since 1980. It has been available for trading for over 30 years, and it has since then become the reference point for market players in the edible oils and fats industry. So I did not include the entire contract specifications here, but instead teased out a few that I think are the most important for everyone to know. So first and foremost, of course, is the contract size. So every FCPO contract which you trade is equivalent to 25 metric tons of crude palm oil. Secondly, for the settlement method under FCPO, it is physical delivery, which means that when the contract enters into the spot month, which is the current month, physical crude palm oil will be delivered from the seller to the buyer. And of course, under this contract, the 15th day of the spot month is when the contract will mature or expire. Okay, this graph shows our FCPO annual volume and open position. So open position meaning how many contracts have not been closed out. So this graph illustrates the numbers from January up to October 2021 this year. So we can see that comparing to 10 years ago, our volume has been increasing significantly, especially since 2020 and 2021. Our open position also has been growing steadily. This signifies a heightened confidence in our contract in terms of providing hedging opportunities as well as trading opportunities for domestic and international investors. Next would be the monthly ADC and open position. So ADC is short form for the average daily contract. So the amount of contracts traded per day. So in 2021, we can see here that the average daily contracts is quite high. It's hovering around 70,000 at the moment. This is very encouraging, especially since, as we can see from the previous slide, the volume has been picking up significantly over the years. So FCPO has seen a very positive, strong, and consistent growth. In terms of the market demography, we can see here it's quite evenly split between retail and institutions, of course. So we can see foreign institutions, so these are the international participants. And at the same time, domestic retail is high as well, together with our local participants who are the professional traders. So it is quite a good and healthy mix between the institutional segment as well as the retail segment, both domestically and in the international space. So our FCPO contract, it's a very healthy mix in terms of demography. And finally, this graph is an intraday volatility of our FCPO contract. So for those of you who are not sure what intraday volatility means, it basically means the up and down movement of the price of FCPO between the opening and close of the entire trading session within 1 day. So as we can see here, from 2020 up until 2021 October, the intraday volatility we can see from this graph is that FCPO has been really, really volatile. So what does this mean? The contract is very liquid. With high volatility, of course, it comes with many trading opportunities for investors, retailers like you guys here on the webinar today, to diversify and, of course, hopefully take advantage of these trading opportunities presented by the volatility. Okay, so now that we've covered FCPO, I would like to touch on our newly launched product, which is the FEPO, or the East Malaysian Crude Palm Oil Futures Contract, or that's the full name. So the FEPO is a ringgit-denominated crude palm oil futures contract as well. And the introduction of this contract is meant to complement the existing FCPO contract, as well as strengthen our palm complex to further consolidate Malaysia's position as the leading price discovery center for palm oil traded globally. So at the bottom here, you can see the features of this contract. Most of the contract specifications are the same. The contract size, again, one contract of FEPO is equivalent to 25 metric tons of crude palm oil traded. The settlement would be physical delivery, and the maturity date would be the 15th day of the spot month. The main difference here would be the delivery ports. So under FEPO, the delivery ports, we have two in Sabah, Lahad Datu and Sandakan, and we have one in Sarawak, which is Bintulu. So a bit of background behind how this contract came about and how this idea was sparked. So we spoke to many palm companies and industry players from East Malaysia, and from the information we gathered, as well as our jurisdictional studies and research, we found that actually the East Malaysian palm oil industry has witnessed significant growth over the years as compared to Peninsular Malaysia. So as you can see here on the top left of the slide, around 1995, East Malaysia only represented 22% of the crude palm oil production in the entire Malaysia, while on the other hand, Peninsular Malaysia contributed 78%. If we fast forward to 2020 last year, it is almost a 50-50 split, with East Malaysia representing 45% and Peninsular Malaysia 55%. So it is this kind of development in the East Malaysian palm oil industry, which it was something which we could not ignore. The fact that East Malaysia now has already contributed almost half of the country's total crude palm oil production. Of course, beyond CPO production itself, we also took a look at the exports of palm-related products over the past 10 years. So as we can see here on this bar chart on the top right, since 2020, the export of palm-related products by East Malaysia has actually surpassed that of Peninsular Malaysia. So what this means is that the export activity in East Malaysia is actually booming. The fact that the export levels are much higher than Peninsular goes to show that the industry there is definitely a really active one as compared to maybe 10 to 20 years ago. So again, this is something which something that we cannot ignore. And of course, finally, one other important piece of background information would be the monthly crude palm oil spread price, i.e. the price differential between Peninsular Malaysia and East Malaysia's crude palm oil between years 2016 and 2020. So as we can see from the chart below, the spread price between Peninsular Malaysia and East Malaysia typically hovered around the range of 46 ringgit, with the highest difference being 132 ringgit, while the lowest ringgit, lower minimum would be minus 72. So on average, East Malaysia's crude palm oil price was trading at a discount compared to Peninsular Malaysia. Okay, in terms of planted areas, we can see here that majority of it, of course, comes from Sabah and Sarawak. So Sabah has about 1.543 million hectares. Sarawak has about 1.585 million hectares of planted areas. And in terms of CPO production, Sabah is producing 4.65 million metric tons, while Sarawak produced 4.05 million metric tons last year in 2020. Okay, so this slide is an important slide. It shows the key differences between the FEPO contract and the FCPO contract. So the first difference would be the trading hours, of course. The FEPO contract begins at 9 a.m., while the FCPO contract begins at 10:30 a.m. Other than that, the contract will take a lunch break at the same timing, and both contracts will close at 6 p.m. So some of you might wonder why did we decide to have the East Malaysian contract start at 9 a.m. while the FCPO currently starts at 10:30 a.m. So the reason for this is because the DCE soybean oil contract opens at 9 a.m. as well. And the idea behind setting our East Malaysia crude palm oil contract to open at 9 a.m. was to provide greater overlaps with the Chinese market. So greater overlaps means for traders or investors like you guys, it will mean greater trading opportunities. The second difference would be the ports of delivery. So as mentioned in the previous slide, the FEPO contract has Lahad Datu, Sandakan, and Bintulu as the three approved delivery ports, while on the other hand, the FCPO delivery ports are all located in Peninsular Malaysia, with them being Port Klang, in Pasir Gudang, as well as in Butterworth. And of course, the final difference would be the position limits. So as we can see here, the position limits for the FEPO are half that of the FCPO. So position limits basically means the total number of contracts which any investor can hold at any one point in time. So for the FEPO contract, on the spot month itself, which is the current month, it would be 800 contracts. And then for any one contract month except for the spot month, it will be 10,000. And the position limits for all contract months combined would be 15,000 contracts. So the reason for having the position limits to be half of that of FCPO is that because this contract is a new contract, and for those of you who don't know, FCPO used to have the position limits which we see now for FEPO. It's only when FCPO became really liquid and mature that was when we decided to double up the position limits. And of course, another thing to note would be that the trading days for FEPO follow KL business days as seen in FCPO. So they do not follow the East Malaysia business days. Okay, trading performance of FEPO since its launch. So FEPO was launched on the 4th of October this year. As we can see, the trading performance has been encouraging. It is a new contract, so it takes a while for liquidity to build up. FCPO has been around for 30 years, and it took a while to get to where it is today in terms of the liquidity, the maturity, the the composition of the people who are actually trading it. So this is what we are trying to achieve for FEPO as well. So the start for now, in the past 1 month or so, we have seen the trading volume about 40 to 50 contracts traded a day. But of course, with currently the market makers, as well as with our constant branding and awareness in East Malaysia itself and on webinars explaining to the audience, target audience, like people like you guys, on how the contract works and why it can be useful for everyone, we are definitely confident that this contract will pick up in terms of trading volume. So with FEPO, right, of course, we have certain incentives in place to encourage people to trade. So one of it will be the 3-for-1 waiver, as we like to call it. So what this 3-for-1 waiver means is that for every 3 lots of FEPO traded, you get a waiver of the exchange and clearing fees for 1 lot of FCPO. The second piece of information which is useful for anyone who would like to trade FCPO and FEPO is that we have a FCPO FEPO inter-contract spread credit of 70%. So what does this mean, right? Currently, FEPO's margin is 5,000 ringgit, while FCPO is 7,000 ringgit. What this means is that the total amount of margins you pay would just be 30% of the 5,000 plus 7,000 ringgit margins combined. So it's kind of like a discount. Okay, moving on. So this slide will touch on the virtual trading derivatives trading simulator, or the DTS for short. So this DTS was a recently launched platform for the market. It's really important and it's really useful for many of you out there, especially if it's your first time trading or you're new to trading, or if you have certain trading strategies which you have not tested it out yet, or you would like to test it out. This would be the perfect platform for you to do so. The DTS basically involves real-time market data, price ladder, sophisticated chart tools for you, and customizable orders and positions monitoring, allowing you to experience real-life trading while at the same time you are trading virtual currency. So you get all the benefits and the experiences of real-life trading through this derivatives trading simulator. So we highly encourage all of you to check it out. You can go to this the link up here, the website www.bursamarketplace.com/mkt/DTS. Alternatively, you can scan this QR code, or you can also take a screenshot of this slide if you would like to look back at it later. If any of you decide to go into the Bursa Marketplace website, this is the homepage that you will see. You just have to go under Tools. The drop-down list will come up, and then just click on Derivatives Trading Simulator. Yeah. So how do we register? So firstly, of course, step 1 would be you have to access the DTS microsite at the link provided, and then you click Start Now, and then you complete the form that you can see here, fill in your details, and after that, you're ready to go. So just a gentle note for everyone that the free subscription account is only valid for 30 days. So you have 30 days to experience real-life trading via this trading simulator. And that concludes my presentation. Thank you very much, everyone, for tuning in.
Thanks a lot, Nicholas. Now, please allow me to introduce our second speaker. He's very experienced speaker. Now, his name is Nelson Lau. Nelson Lau serves as Executive Director, Agricultural Products, and is responsible for driving the growth of the CME Group's agricultural commodities product line throughout the Asia-Pacific region. Nelson joined CME Group in 2008, and he has more than 20 years of experience in the global commodities market. And Nelson has a bachelor degree in chemical engineering from the National University of Singapore, and he is also a chartered financial analyst. please allow us to pass it over to Nelson. Nelson, are you ready?
Yes, definitely. Thank you, Ting Ting, for the very warm welcome, and thank you to Bursa as well for inviting me to speak. It's always a pleasure to talk to East Malaysians. In fact, I think this could be my first time speaking to East Malaysians, and the reason why I say that is because when I was a young man that just graduated from university, the very first backpacking trip that I did was actually through East Malaysia. So there's a lot of very warm memories and good memories that I had. When Nicholas mentioned Bintulu, straight away I remember what Bintulu looks like, and I've also had the pleasure of climbing your fabulous mountain, Mount Kinabalu. So the view there is just amazing. I'm very blessed to have been able to travel there, and very blessed to encounter the people of East Malaysia as well. So thank you very much for that fantastic experience. Okay, I'm gonna start by sharing my slides. So let me pull them up first.
Yep, you're good to go.
All right, okay, good. Okay, great. Today what I'm going to touch on is both CME and BMD products. Nicholas has done a fantastic job talking about the BMD products. I learned a lot today. There were things that I didn't know, and I learned them, and I hope that the audience as well will learn a few new things as well through this presentation. Maybe let me just begin with this slide. So commodities. In case you're new to commodities, I'm pretty sure everybody on this call is familiar with commodities, given the fact that as Nicholas had mentioned, a very big part of Malaysian GDP is from palm oil. So I'm pretty sure most of you are familiar with that. But I wanted to just share as well that there are many other commodities throughout the world. And what you see is that there's this commodity index called the Bloomberg Commodity Index that details out the different commodities that are available. And you see that the agriculture commodities constitute almost 1/3 of the Bloomberg Commodity Index. So it's a very, very important part of the commodity world. And of course, at the CME, we have a various suite of different products within the agricultural space, and you'll see that we have broken up into these four main classes: grains and oilseeds, livestock, dairy, and other agri products. Grain and oilseeds is our biggest product suite. You'll see that you see the finer details here, but really the product class that I would be touching on today and focused on today would be the edible oil suite. And the CME, or rather the Chicago Board of Trade, is most famous for the soybean oil contract. And I will be talking a little bit about the soybean oil contract. Okay, so, maybe let's just take a step back. Where does edible oil come from? It certainly comes from some sort of agricultural plant. And in the case of palm oil, it comes from the palm oil tree, and you get the oil from the palm fruits. In the case of soybean oil, you get the oil from the seed. So when you eat soybeans, I think most of us here, you in some time, or you may have come across, and perhaps due to your dietary considerations, you may not have tried it, but I'm pretty sure that in East Malaysia, you have what is known as yong tau hu, right? So when you eat yong tau hu, or you've seen your friends eat yong tau hu, you know that it's made from the humble soybean, and they throw a lot of soybeans into the yong tau hu as well for you to eat. And that yellow bean is a very magical bean. You can use it to produce two very important commodities called the soybean meal and the soybean oil. What happens is that it's a process known as crushing. You put the soybean into this big machine, and you squeeze the oil out of it. Very similar to what's being done in palm oil as well. And the oil is the liquid portion of the soybean, whereas the solid part that comes out is known as soybean meal. Soybean oil, as you know, very similar to palm oil. It's used in many of the same applications that palm oil is used for. It's used primarily as an edible oil in cooking. But these days as well, a lot of that oil is also being used for what you call the production of biodiesel. The oil is converted into a different kind of form, and that form of oil, usually known as a methyl ester, is then added into diesel fuel to make a blend of biodiesel and diesel. Soybean oil is very widely produced and consumed around the world. China, in fact, is the world's biggest producer and consumer of soybean oil. Now, you don't hear very much about Chinese soybeans or soybean oil around being, in the supermarket, if you were to go there to buy something. And the reason is because China has such a huge population that everything that they produce, they consume on their own. And that's the reason why you rarely see a Chinese-made soybean oil bottle. But nevertheless, they are the world's biggest producer and consumer of soybean oil. Soybean oil, along with palm oil, are the two largest edible oils in the world, and they constantly compete for market share. And in the next few slides, I'll talk a little bit about the balance between these two oils and how potential trading opportunities can come from it. Okay, so maybe let me just walk you through a little bit what does the Chicago Board of Trade soybean oil contract looks like. It's a very liquid contract. It's traded for many years, for almost maybe 70 years now. And volumes are extremely heavy, especially this year. This year has been a very heavy year because there's been a lot going on, and I will explain to you in the next few slides what has been happening. But let's start first with the soybean oil futures contract. If I may just explain a little bit here. The contract size is in pounds, 60,000 pounds. Most of the American contracts, they tend to be in what we call the imperial system. So we'll follow things like pounds and bushels and some measures of weight that we are not familiar here in Asia. We are familiar with the metric system, but the Americans, they use the imperial system. So they still use pounds in America, but it's a very easy conversion. And in essence, basically 60,000 pounds is more or less around 27 metric tons. So it's actually very similar to the Bursa Malaysia contracts for palm oil, which are 25 metric tons. The other thing to take note is that it's physically delivered as well, very similar to FCPO and FEPO. But of course, it's a different contract. So you have different contract months. In this case, the Chicago Board of Trade doesn't list all of the contract months. We only have selected numbers. There are 8 contract months in a year that we list. And of course, the expiry and settlement schedule is slightly different. The trading hours are of course different. It's a different exchange. So you have, in this particular case, you can trade them from Chicago time between 7 p.m. to 7:45 a.m. and then from 8:30 a.m. to 1:20 p.m. So almost the whole day. You can trade almost 20 hours in a day for this particular contract. The other thing to take note as well is that there is also an options contract on soybean oil. For those of you in the audience who are familiar with options, the soybean oil options contract offers a great opportunity for you to take or make a position in options for soybean oil. Okay, so so when we talk about soybean oil, we need to always look at so maybe just to give you a bit of background, I came from the physical trading world, and in the physical trading world, you call the physical traders, they look a lot at what is known as fundamentals, basically supply and demand of the marketplace. And that's what I've spent my initial few years in work learning the supply demand balances for soybean oil. And when you look at the fundamentals, you always look at the supply side and then you look at the demand side. So in this particular case, let's look a little bit at the supply. Let's look at the production. This is a chart on the United States soybean oil production in metric tons, and you see that this is a very long-term chart. There has been a very consistent growth in production over the course of the last almost 50 years. And that's because of the popularity of soybean oil in many uses, and that has continued to grow as time has gone on. So you see that the production has increased, and the same goes for the world. If you look at the production, this is the same chart, but instead of just the United States, it's a chart for the world. And you see that the production has also grown dramatically. Now, obviously, many times in commodities, supply tries to meet demand. And the main driver behind all this growth in supply is simply because demand has been out there asking for supply to increase. And this other chart, it's a little bit busy. I will try to explain it in a little bit more detail. What you see here is that whenever traders look at supply and demand, they will always determine, once you take the supply and you subtract the demand, you have what is known as the leftover, right? Supply is what you produce. Demand is what you need to use. The leftover, the difference, is what we call ending stocks. And ending stocks here in this chart are the orange bars. The blue line that you see is what we call the stocks to use ratio. So that's the ratio between the stocks, the ending stocks, and the usage demand. So if you think about it, the lower the stocks use ratio, that means if the lower the blue line is, it means that there's less stocks to fulfill the demand of the world. And in this particular case, this chart is for the US. So it will mean that there's less stocks to fulfill the demand of consumption in the United States. And if the blue line is very high, it will mean that there's a lot of stocks in order to fulfill the demand of the US. So in this particular case, if you were to look at this chart, and I'll explain this, the blue dot for this year is roughly around 7.5. So what does that mean? It means that you can only fulfill with the amount of ending stocks at the end of the supply versus production. At the end of the production versus demand, it can only supply 7.5% of the demand. Okay, that may sound very little, but in effect, it's actually a decent amount, simply because of the fact that the world has become very sophisticated in managing supply chain. So you don't need big stocks like 50% in order to make sure that factories are running and equipment is smooth and vehicles are being driven. You need to maintain a certain level of stock. But when that stock drops too low, then that's when you get into a lot of trouble, because it means that demand is very, 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 very high and supply is very, very low, and the stocks are very low. And that's when you can get the market in a very volatile situation to the upside. Okay, so we've looked at that. And the other thing that we look at as well is we look at the other oils. When you consider any single oil, you need to look at the other oils as well. What are they doing, right? And this is a chart of the 4 major oils in the world: the soybean oil, rapeseed oil, sunflower oil, and palm oil. Now, of course, no need to be too worried about rapeseed oil and sunflower oil. They are important oils, but however, in terms of production, they are nowhere close to the amount of production of soybean oil and palm oil. All right, but of course, if you want a very full detailed analysis, these are the 4 major oils that you need to look at. There are many other oils as well, right? There's peanut oil, there's corn oil, right? There's so many other oils in the world, but these are the 4 major oils, of which among these 4, the 2 biggest are palm oil and soybean oil. So before I go a little bit further into talking about some of the nuances in the marketplace, one thing that I want to draw your attention to is that one of the very popular spread trades between the 2 biggest edible oils in the world is actually trading that spread between the Chicago Board of Trade soybean oil and the BMD crude palm oil. In this case, the BMD crude palm oil is the FCPO contract. Now, of course, with the launch of FEPO, as Nicholas had mentioned, now you can actually trade the spread between the Chicago Board of Trade soybean oil and the BMD FEPO. And of course, if you were to read this paper, you can learn more about this spread trade and over time, as you understand it more and more, you will be more experienced. Okay, so besides that trade between the two edible oils, there are other spreads that people look at. And one of the spreads that people look at, and I'll come back to the spread trade between palm oil and soybean oil in a matter of time. But let me touch first this spread trade between palm oil and gas oil. So there's two really very big spread trades that traders look at, and they look at what is known as POGO, P-O-G-O, which is the palm oil gas oil spread. And they also look at what is known as the POBO or BOPO, the palm oil bean oil spread. I'll talk about the first one first. The first spread, POGO, quickly here, and just to give you a bit of an overview. So why do people look at palm oil versus gas oil? They look at it for the simple reason that palm oil today, as mentioned, same as soybean oil, a significant portion of it is being used to produce biofuel, biodiesel. And biodiesel competes against diesel, which is the crude oil version. Now, what is gas oil? Gas oil is basically diesel. It's the same name for diesel. So people do look at this spread trade because these are what you would consider competing usages of palm oil. And you see that while that spread has moved around quite a bit, you see that it currently right now is at the highest level in the past 20 years. So there's a lot of attention being looked at it. The obvious logic is that amongst many different things, obviously the situation in palm oil today is extremely tight. And that's the reason why the POGO spread is as high as it is. The other spread, which I said I'll come back to and talk about, is the POGO spread, which is the palm oil bean oil spread. And this is a 25-year chart. And you'll see that the POGO spread has actually moved around quite a long. It's quite a volatile spread trade. Now I know this slide is a little busy. I will try to help explain a little bit of the slide. What you see at the top left hand is basically the price charts of the two edible oils. The chart on the lower left hand corner, that is basically the spread. So it's basically the price of bean oil converted into US dollars per metric ton. Remember, it's in pounds. So you need to convert it from US dollars per pound to US dollars per metric ton. And then we take the price of the Bursa Malaysia FCPO, and that's in ringgit per metric ton. So we convert that from ringgit into US dollars, and you have US dollars per metric ton. So now you're comparing the same two conversions. And when you do that, you take one and you subtract the other. That's your spread. And this is the spread that we've seen over the last 25 years. And you see that it's quite an interesting spread. It's moved it's gone up and down through the years. But what I notice are two very specific things. One is that if you look at it, a lot of the dispersion or a lot of the prices over the years tends to be clustered around this line. And I don't know whether you can see my cursor, but if not, just imagine there's an imaginary line somewhere along this spread line. And you see that the chart here on the lower right-hand corner, that is basically the mix of data points. And you see that on the upper right-hand corner, you see that there's a mean and a median. And you'll note that the mean and median is roughly between 94 to 115. So what that kind of tells you is that tends to be the average spread between the palm oil, bean oil versus palm oil. But of course, I mean, you know, it moves around, as you can see. It moves up and down. And in fact, this year happened to be one of the most volatile years where the price of palm oil the price of bean oil went up so sharply that that spread reached $569 per metric ton. And that's a 25-year high. And of course, but as you can see, that spread is slowly coming back, and it's right when this chart was produced, it was back down to $135 spread. So you can see it's a very interesting thing. A lot of traders look at this; they like to trade this spread, and again, it's a very interesting spread. I'll talk a little bit more about it. I'll help you guys understand exactly how to do the calculations, so you have a very good idea of how traders in the world look at this spread. Soybean oil, as I mentioned to you, there's a lot going on this year as well, just as much as there's a lot going on in palm oil right now. And in fact, what you see is that since 1958, soybean oil has actually at its all-time high, and one of the top 3 records you can see has been set over the last 20 years. From 2008 was the second highest ever, and 2011 the third highest ever, and all these are all within the 21st century. So a lot going on in the marketplace, and you can see that this year has been a very volatile year for soybean oil. I wanted to talk a little bit about that linkage between diesel and edible oils. And here is something that you will see. The Western Hemisphere is driving a lot of the demand for biofuels, and that's partly because of the fact that the Western countries they have what is known as a renewable mandate, a renewable fuels mandate, where they actually require companies to, when they sell fuel, to sell fuel with a certain percentage of renewable fuel in it. This can be in the form of biodiesel, this can be in the form of renewable diesel. They're slightly different. I'm not going to go into the details of the difference between them, but in essence, basically, the Western world is beginning to use more and more biodiesel or biofuels in their energy mix. And as you can see on the charts, both on the left and the right, one is the European demand. The one on the right is the North American demand. And you can see that demand will continue to grow over the years. And that has been partly a factor that has actually driven prices to all-time highs this year. Amongst other factors, of course, there are other weather factors at play. But this has been a very big driver in the move in prices up this year. Now, where it goes from here, I don't know. But one thing is for sure, it seems that the renewable diesel demand is very strong, and it will continue to grow over the years as both Europe and North America require companies to implement renewable mandates. Okay, so I said I wanted to talk a little bit more and give you a simpler way in which to understand it. So it's actually pretty straightforward, right? Soybean oil and palm oil, the 2 biggest edible oils in the world, they are somewhat substitutable. You know, if you were to produce a biofuel, you know, you could use soybean oil to make soybean biodiesel. You could use palm oil to make a palm oil biodiesel. They're substitutable. Even in the cooking marketplace, you could use soybean oil to cook your food. You could use palm oil to cook your food as well. So they compete, right? They're substitutable oils. They're competing oils. Traditionally, palm oil has been generally considered cheaper. And as you've seen in the spread chart, you'll notice that that spread is more or less always in the positive territory, meaning to say that soybean oil minus palm oil is always a positive number. So hence the market tends to always price soybean oil higher than palm oil. India and China are both big consumers. They are very price sensitive. This tends to create some swings in terms of demand. When palm oil gets too expensive, they may switch over to use soybean oil. When soybean oil gets too expensive, they may switch over and use palm oil, and vice versa. So that tends to play a little bit of a balancing factor in terms of demand between soybean oil and palm oil. So all these different factors creates a balance, and whenever there's an imbalance, it creates trading opportunities on the price spread. And hence the reason why this spread is a really interesting spread for that a lot of people look at. Now, how do you evaluate the spread between the two? It's pretty straightforward. What you do is that you look at the palm oil futures price, okay, and then you subtract, and then vice versa. You have to adjust, as I mentioned, how you adjust for both the size and the currency, and vice versa. And once you convert them both to US dollars per metric ton, you have the difference in prices. Now remember that soybean oil is 60,000 pounds, which is roughly 27 metric tons. So if you were to trade one contract of soybean oil versus one contract of palm oil, it's not exactly the same because palm oil is 25 tons. So you actually have to trade it. If you do the math, it works out to an 11:12 ratio. But you know what? Most traders just tend to say, I'll just do this in a 1:1 ratio. But to be exact, it's really an 11:12 ratio. Most traders look at it from the perspective where they'll trade same month pairs, meaning to say that they'll trade, say for example, if it's a December soybean futures contract, they'll trade it against a December palm oil futures contract. But of course, I mean, there are nuances, obviously, because in FCPO, the most liquid month is the third month forward. So you might want to take that into account as well. And finally, the last bullet point is a simple example of how you do exactly what I just described in the last 5 minutes. And with that, you're able to actually calculate out that spread. So when you do this calculation, you actually will come out to the same chart, the one that I've shown you already. And basically that's how you look at it. Now, FEPO, great opportunity there, as Nicholas had mentioned. And I took the chance to go into my Bloomberg to look at the same chart, the one that I just described to you, and pulled out the data for it. Now, of course, FEPO is very new, and hence the data isn't as significant as FCPO. But however, you will look at there are some interesting things going on as well. The spread chart is the middle chart there, and you see that spread seems to be hovering between $200 to $250 versus soybean oil. And I believe Nicholas showed a chart of the spread between FCPO and FEPO as well. So all these charts tying together, they tell the same story, and that story is a very dynamic story between the different forms of edible oil. So lots of interesting things going on as well in FEPO. Okay, I'll leave you with one more popular spread that people look at. This one involves more soy oil and soy meal. As I mentioned before, soy oil and soy meal come from the soybean, and there's also a relationship between the two as well. And that relationship is known as oil share. Now, what does oil share mean? Very simply, both of these two products, the soybean oil contract, the soybean oil contract, and the soybean meal contract, both Chicago contracts, you see that they are actually produced from the same soybean. So, and there's a relative value between the two of them. Most people use the term oil share to sort of understand, explain the price of oil relative to the price of the soy oil and the meal. So the formula is normally expressed as you see here in the fifth bullet point as the price of soy oil divided by the combined price of soy oil and soy meal. So in other words, it's the price of soy oil compared to the price of the two components of the crush, right? It's quite logical, and that ratio tends to tell you the value of oil in the soybean. I will not go through you all of the math. You can have a look at it here. Again, if you want, as Nicholas had mentioned, you can take a photo of this And it's simple, straightforward math. The only thing that you want to know the difference between this and the palm oil soybean oil spread is that this particular spread is known as a ratio spread. And a ratio spread is slightly different in the sense that you need to calculate a ratio between the two products. And a ratio basically means you trade them in what we call a notional value equivalent, which means to say that you trade the same value or the same notional value of soybean oil versus the same notional value of soybean meal. And when you do that notional spread, then what you do is that you're basically trading the percentage, or rather the oil share. And this is what and once you have the notional trade, and here's a simple example. For example, say one soy oil contract, after you do the math, it comes out the value of it is $23,000, for example. And one soy meal contract, the value is, say, for example, after you do the math, is $35,000. Then you take 35 divided by 23, and in this example, you get 1.55. So it would mean to trade an exact ratio, you will need to execute 155 contracts of soy oil for every 100 contracts of soy meal, right? 1.55, right? Or if you were to divide it down further, it will become 31 contracts of soy oil for 20 contracts of soy meal. Now, again, just like in the previous slide where it's 11:12, in this case, if it's 31 versus 20, some traders would just say it's just too big. I'll just trade in a ratio of 3:2. So again, it's really up to the trader's decision. But basically, this particular spread trade is always done in what is known as a ratio. Last but not least, this is what oil share looks like, as mentioned earlier on. And you see that oil share fluctuates a lot, but basically it shows the value of oil versus the value of the products that come from the soybean. And the thing that has really caught a lot of traders' attention this year is that the oil share has been on a very sharp trend upwards. And again, back to back to a few slides before this, it's largely driven by the activities that's going on in the renewable fuel space. That's driving up a lot of demand for edible oils, and hence the oil share value of the soybean is becoming more and more important. That's a very telling sign. It means that if the value of the soybean, now people or buyers are placing more of the value of the soybean on the oil side rather than the meal side. Okay, whereas historically, you see that people tend to place the value of the meal more on the soybean than on the oil side. Okay, I'm not sure whether I managed to explain it precisely enough, but that's more or less the thinking behind what an oil share is. All right, and I know I'm sort of out of time, so I'm just going to take the last couple of minutes to walk you through some of the resources that are available. There are quite a number of educational resources available for free on the website, and you'll see these are all the links to resources that will help you learn more about not only soybean oil, but also about palm oil. And I just want to highlight one of the particular reports, which is the weekly grain and oilseed report. This is something that you can get sent to your inbox, email inbox well, it's bi-weekly now, once every 2 weeks. And you can have it both in English and in Mandarin. It's available in both. You can sign up at these links. And once you sign up, you put in your email address, you get it sent to you once every 2 weeks. Okay, and I would say I am at the end of the presentation. Thank you very much for your attention.
Now, right now, we are going to open for Q&A session. What you need to do is you can click on the Q&A box. Can you see the Q&A box? So please don't send a question into the chat box, just send it into the Q&A box. And once finished typing your question, what you need to do is please send to all co-hosts. So we are going to start with some of the questions, and we are going to answer your question. Well, there are many questions. Let me start to pick up some of the questions. Now, the first question is for you, Nelson. Do we need to consider daylight saving time when trading US futures?
Yes, of course. Singapore and Malaysia, we both operate on, I don't know what the exact phrase is. Our hours do not change. So we don't have daylight savings here. So we will have to obviously adjust the timings whenever we look at the Chicago market. So for example, right now, it should be 9:30 p.m. Your time and my time as well. Ting Ting, am I correct? Is it the same time in South
Yes.
Sarawak? Okay.
Yes, we are brothers and sisters.
Okay, all right. So it's 9:30 p.m. for us, but it's only 7:30 a.m. in Chicago now. But when it's daylight savings, it wouldn't be 7:30 Chicago, it will be 8:30 a.m. Chicago. So they actually move by an hour. So you have to take note of that when you consider the opening hours. So the markets are currently right now suspended, as in the break between the what we call the US night session and the US day session. The day session will open at 8:30 Chicago, so that would be in an hour's time.
Okay, the next question is also for you. When does the agriculture futures fundamental data release? So that's the first part. The second part of the question is, where can we get those data?
Okay, great. Now, one thing that is really, when I started as a young trader, one thing that I was really impressed with is that the US has a lot of data, number one, and number two, the data is all for free. And you can get a lot of data. I can't even begin to tell you how much data there is. There's so much. But one of the big data that a lot of traders look at is what is called the WASDE report. WASDE stands for World Agricultural Supply and Demand Estimates. WASDE. So very simple. All you have to do is go to Google, Google WASDE, and you will have the links that will send you straight to the sites where you can actually find all the global supply and demand data available. Now, the reason why all this data is available is because the United States Department of Agriculture, USDA, they publish a lot of this information for free. So feel free to explore their website. They carry a lot of data, not only the World Agricultural Supply and Demand Estimates. They have reports on edible oils, they have reports on soybean oil, they have reports on palm oil. They have a lot of information out there, and everything is available for free because that's how it is in the United States. There is freedom of data.
Okay, very good. Now, the next question, very interesting question. This one is for you, Nicholas. So the question is, why not add the East Malaysia ports to the FCPO contract instead of launching a new contract? I'm not quite sure whether this is the question that you're going to answer.
Yeah, thanks, Ting Ting. So, yeah, it's a question we get a lot actually. So, the reason why we decided to launch a separate contract from the FCPO is that because, as mentioned earlier in the presentation, the FCPO is a physically delivered contract. So, in the spot month itself, sellers would physically deliver their crude palm oil for the buyers to pick it up. So under this physical delivery process, the seller is the one who gets to choose where he wants to deliver his oil. It's not the buyer does not have the option to choose where he wants to pick up the oil from. So when we take that into account, if we were to include the East Malaysian delivery ports into the FCPO contract, it will actually cause a lot of logistical challenges, to say, for the physical player. So for example, imagine if the buyer currently he is based in Pasir Gudang, Johor, right? And then he has been randomly allocated to pick up crude palm oil from Bintulu. That is something which, of course, through the course of our engagements with the industry, we found out that that is something which is very challenging and unappealing to a lot of them. So because this is a physically delivered contract, we had to take into account the fact that this could cause quite a significant disruption to the existing FCPO contract. Hence, we felt that having a separate contract would be the best way forward for this.
Okay,
Thanks,
good.
Ting Ting.
Now, the next question, I'm not quite sure who is going to answer this question. So the question is, what is the correlation between soybean oil, and also CPO?
Yeah, maybe I can take that, and then Nelson can probably give more input. So the correlation between soybean and CPO, definitely it's a positive one. So what that means is if one goes up, the other one is likely to go up. For example, if you can think of it this way in this example. So for example, if the price of soybeans were to go up in the US, for example, then we will most probably see an increase in imports of palm oil. So in a way, you can see them as substitutes, and that's how they are correlated.
Nelson, do you want to add anything?
Yeah, sure. I'll be happy to add. So Nicholas, exactly correct. They are positive correlated. One very easy way to see correlations or to understand the level of movement between them is by looking at margin offsets. Nicholas mentioned there's a margin offset when you trade FEPO and FCPO. That kind of tells you how well correlated they are. The higher the offset, if the clearinghouse or the exchange requires less margin to be collected from a trade between the two contracts, it obviously means that they tend to follow each other closer, right? So say, for example, you have a 90% margin offset. It will kind of tell you that these two are very closely correlated. If you have a 10% margin offset, then that kind of tells you that the correlation is still there, but it's not as good and it's on the low side. So the correlations between bean and soybean oil, they change every now and then. We do change the margin offsets between them. This year they've not been as good because there's been a lot of movement in soybean oil relative to the soybean prices. So that correlation has actually come down. But however, the correlation between, I think, bean oil and palm oil has been fairly stable over the years. But however, this year again has been a very exceptional year. Soybean oil made a big rally at the start of the year, but palm oil didn't really follow. But the reverse happened. Then palm oil is making a very big rally now, but soybean oil isn't following. So this year has been a little bit of an odd year. And you have to look back in history to have a better idea of that.
Okay, very good. Now, the next question I think is also for both of you. Now, why does the recent food crisis cause soybean oil price to go down while CPO price to go up?
I can try to answer that first, and then Nicholas, please jump in if you like. So I think you're kind of talking about the last few months, what has happened in the last few months, because the price of soybean oil has been coming down, but the price of palm oil has been going up. So again, to the earlier question, it's been a bit of an exceptional year this year. It sounds like you have been following these markets for some time. So you obviously have noted in the past they tend to follow each other quite well. This year again, a very, very different scenario this year. Great if you're a spread trader, then you trade against the spread. bad if you had thought that the correlation was going to be really good this year, and you can follow the trend, such as trading, right? So to answer your question exactly, it's because there was a very big weather scare in the US market in the middle of the year, and that drove soybean oil prices to historical highs. Palm oil did not follow as heavily as what soybean oil was doing, because that was a very specific weather-related price move. And then subsequently, the weather eased up. The price of soybean oil came down, and then I think the attention shifted to palm oil, and the supply issues for palm oil began to come into play. So I think that's a little bit of a mismatch. Again, I would believe, Nicholas, you're probably more well versed on palm oil than I am.
Yeah, thanks, Nelson. So in the case of palm oil, what we have seen last year and this year, of course, is that in Malaysia there was a severe labor crunch. So because of COVID-19, the pandemic, we had a shortage of foreign workers working the plantations. Hence, we saw a really severe shortage in supply. So all of these factors, of course, drove the prices of CPO up. Yeah.
Okay. Now, the next question, I think, is by beginners. So her question is, this one is for Nicholas. If I want to start trading FCPO or FEPO, how do I start? Maybe can you give a rough elaboration, or where can they access?
Yeah, thanks, Ting Ting. So okay, so of course, to start from a process perspective, you have to first open a futures trading account with a local futures broker. So if you are not sure who to pick or who are the brokers, you can always go to our website, bursamalaysia.com. And if you go to the main page under, I think it's trade and trade resources, you can see a list of brokers with the relevant contact information. So that's your starting point in terms of opening an account. But if you are talking about trading the two contracts itself, of course, I think a lot of it goes back to what Nelson mentioned in his presentation as well, that definitely reading up all the data and information relating to palm oil is really important. Like most things, you have to familiarize yourself with the subject in order to be able to do well. So from a trading perspective, I think that's a good starting point to really read around the subject, familiarize yourself with crude palm oil. Especially in Malaysia, there are certain useful resources you can look at. For example, the Malaysian Palm Oil Board, or MPOB. MPOB's website has a lot of data relating to the physical industries. For example, what's the price of palm oil, the stock levels, the exports, where is Malaysia exporting to, these kind of information. So definitely reading is important. Yeah.
Okay, very good. Now, the next question is for Nelson. Is the commitment of traders report useful for making analysis? Maybe would you want to elaborate a bit?
Yeah, sure, of course. That's a really great question.
Very good.
I mentioned the WASDE report. That's the World Supply Demand Estimates report. I also said there are many other reports as well that traders look at. One of the other reports that traders look at is the Commitment of Traders report, as you mentioned. So the answer to your question is yes, there are traders that do look at it, they analyze it. I would say probably, it's definitely worth you looking at it and understanding it. Do your own research, make sure you understand it, what it is. It's a little bit of a laggard indicator in the sense that I have to look up the exact release dates, but I think they are maybe about 5 to 7 days delayed, meaning to say that when you get the Commitment of Traders today, it references the position sometime last week. So you have to take that into account as well. It's not live data. It's not, what is the position today or, yesterday. But yes, to answer your question, yes, a lot of traders do look at the commitment of traders report.
Okay, I think the next question is for both of you as well. Why does the commercials and big traders behave so differently?
Yeah, maybe I can
Maybe
take that
towards
first.
Bruce's side first.
Yeah. So I think the main difference would be, of course, the objective of trading for the commercials and the big traders. Commercials, for example, like a big palm oil company. Of course, when they do trade, they have different objectives. One would be to hedge the fluctuations in crude palm oil prices, which is, as mentioned, it can be quite volatile. At the same time, also similar to these big traders, as you call them, these guys, they are out to, put it bluntly, trade to earn money lah. Yeah. So I think it really depends on why they are trading and what is their objective, what they're trying to get out of trading. So it really depends from company to company as well as individual to individual.
Okay. Now the next question is, I think it's more towards Nicholas. Is it wise to compare the price of soy oil futures while trading CPO futures? More common question.
I think they are definitely related. You definitely cannot or should not ignore one or the other when you're trading one or the other. But if you're talking about whether it is a main indicator, I don't think it's wise to treat it as a main indicator, because like what Nelson has presented in his presentation, there are many factors affecting any one contract which you trade. So definitely read around and understand the contract you're trading to have a more holistic view as to what would be the best indicator for you to follow.
Okay, I think the next question should be for Nelson. So the question is, soybean oil and FCPO are currently trading in premium while soybean is trading in discount. Any reasons that cause this to happen?
Okay. To be honest, I don't fully understand the question, but I'll try to explain. I'll try to explain it as how I understand the question to be, and I apologize if it's not correct. So if I understand you correctly, what you're saying is that soybean oil and palm oil are trading at a premium, meaning to say that they are more expensive than soybeans. Now they're actually very different commodities. They sort of are a little bit of, oh, I'm sorry, I think I just saw your point. Okay, you're talking about front month premium. Got it. Okay, so what you're saying is you're basically saying soybean oil and palm oil are in what we call backwardation, while soybeans are in a contango. I understand what you're saying. So usually when the market talks about contango and backwardation, backwardated markets tend to be markets that are short in supply. So there's a lot of demand but very little supply. Contango markets are usually markets where the market is big in supply, so there's more supply than demand. So that's what's going on in both of these markets. There's a lot of demand for edible oils, whereas there is less demand than that in the soybean market. So that's the reason why you're seeing them in their relative premiums and discounts.
Okay, very good. The next question maybe for both of you, or maybe towards any of you. The question is a very interesting question. It said fundamental trading in regards of fundamental tradings, is it advisable to fade the move after a big data release?
I'll start with that. I don't really have a view on that. You know, you hear people say buy the rumor, sell the fact. I guess that you know, I guess sometimes that's true, sometimes that's not, right? So
Yeah, I think it's same for me. I don't have a particular view on this fade the move concept. Like most things to do in trading, there's risk, there's reward. I don't think there's a set answer, fix a guarantee to anything. It all really depends on your trading strategy and how much of a risk taker you are.
Okay, Nicholas, this question is for you. So I noticed that most of the time FCPO react to soybean oil futures price. Do you think that I can use it as an indicator to trade in FCPO? Can be slightly the same as the previous question, but might be slightly different because he wanted to use it as an indicator.
I see. Okay. Yeah. So as I answered earlier, definitely you can use it as an indicator. You should definitely have it as one of your considerations when you are trading FCPO, like reading around, right? You look at soybean and how soybean oil moves. That should give a good picture of what would be happening in FCPO as well. But again, just to emphasize, it should not be the only indicator that you look at when you trade.
hey,
Okay.
I also like to jump in on that. I find it a very interesting question. And I like to tell you that when I talk to US traders, they are saying they are following the BNB palm market. So they're using that as an
Interesting.
indicator. So yeah, I guess it's all a matter of perception sometimes.
Yeah, it's interesting.
Okay, the next question for Nelson. Does soybean has any seasonal patterns?
The answer to that question is yes. There is a very distinct seasonal pattern. Before you trade, I'm sorry, this is for soybeans or soybean oil?
Soybean.
Okay. Yes, there is a very distinct seasonal pattern. So, you know, before you trade soybeans, I would urge you to look at some historical data, understand exactly how the futures curve is made up of. You'll notice that in general, futures prices tend to the curve always tends to be highest around summertime, US summertime. And then the forward curve drops off once the new crop comes in. So it's what you call the old crop, new crop price difference. Generally, the old crop tends to be more expensive than the new crop. As you can imagine, new crop means a lot of supply is coming in. But again, I would advise you to have a very deep study of that forward curve if you're trading medium to long term. You definitely want to know how that curve moves over the course of history.
Okay, we are going to take the last question because of time limitation. Now, the last question is, this one is also towards CME side. So Nelson, maybe required you to answer for this question. Can corn or wheat strongly affect soybean demand?
Yes, they will. Okay, hang on. Corn and wheat will affect the demand of each other more directly than they would affect the demand of soybeans. And the reason why is because the soybean is an oil seed, so there is an oil component in the soybean, whereas the corn and wheat are more a carbohydrate seed. So it's more it's more used for energy. So corn and wheat are probably more similar than say corn and beans or wheat and soybeans. But however, there is a small component that is similar, and that is in the meal. The meal portion of the soybean is used in animal feed, and so is corn used in animal feed as well. They have a different purpose. The meal is more protein, whereas corn is more carbohydrate. But however, you need both when you feed livestock. So there is also some synergy between the two. So I'm not sure whether that answers the question, but They are all slightly different.
Okay, great. So we are going to end our Q&A session. Now, thanks a lot to both our speakers, both Nelson and also Nicholas, for their presentation and also answering all the questions. Very good. Now, before we wrap up, just the last one, just for information, we are going to have a lucky draw. So what you need to do to become one of the lucky winner to win one of the reload pin worth RM100, we are going to give it out for 5 prizes, and these are all sponsored by Bursa Malaysia Derivative. Now, how to become a winner? First, you must answer all the 4 quiz questions. Now, I understand that many of you complain that the previous question is very difficult. You struggle to answer all the questions. But just a tips for you for today's question, right? There's no spread question. And so long as you focus just now and you listen carefully, you should be able to answer all the 4 quiz questions. So later you can access and the link will be given and the password is FEPO. Now, second, you must also complete the survey form. I repeat, you must answer all the 4 quiz questions and also complete the survey form. Now, the cutoff time is 10:30 p.m. So you still have another 30 minutes. So just you just take your time and just finish it off. And subsequently, we will announce the results within a week. But so far, normally we announce within 3 days. Now, to access, what you need to do is you can scan this QR code, or else you can type in excellent.com/bursa, or else in the chat box, the link is being provided. So please don't access at once because many of you are online right now. So if you cannot access, just wait for a minute to 2 before you re-access again. So please remember, to be qualified to be one of the winner, you must answer 4 questions and also complete the survey form. So this comes to the end of our presentation session. I'm so sorry.
Yeah,
Anything
sorry.
you would like to add on?
Yeah, something just popped into my head with regards to the soybean oil and FCPO and who looks at what. That's what Nelson mentioned earlier, that some of the US traders, they actually look at FCPO, right? So I think I just wanted to add on that because when FCPO is trading during the Asian hours, it's actually in the US night. So I guess that's why traders look at both. So for BMD, because we are releasing our upcoming T+1 night session, it will be able to cover the US movements for those who have positions in FCPO. Yeah, so I guess because of the difference in time zones and how the timings that people trade it, that's why they look at both contracts at different times of the day. Yeah, just wanted to elaborate on that question. Yeah, thank you.
Okay, very good. Now, so this comes to the end of our session for tonight. And thanks a lot for your participation. And really thanks a lot to both of our speakers, Nelson and also Nicholas. And we wish you, and we are going to see you in the near future. And stay safe. Good night. Bye-bye.